Hello, everybody. Like, so I'm trying stuff just to see if I can get this show to float the way I need it to float. So we trying some stuff. I gotta get some stuff. I'm gonna say we have moved up to about like being 85% rolling with this. Y'all, I just jumped right in. Welcome to another episode of Talks with the Tax Cop. I am yours truly, none other than Patrice L. Berry, EA. So, for those of y'all who are watching on the screen, looking at YouTube, y'all, I am Patrice L. Berry, the principal founder and owner of Total Tax Experience. I am an enrolled agent. That means that I specialize in all things tax, right? And so, on Talks with the Tax Cop, we do several different things. We take the time to break down concepts, get things together so that people can understand what is happening in these tax streets, especially the internet, right? So it's so much information going on. And we also take time to interview small business owners. Why? Because my heart is for the small business owner. I get it. I totally get it, and want to be able to put the small business owner in a position that he, she, they can be able to leverage the tax code and make sure that they are in front of it. I want to be able to interview people that are in business so you can see that our origin stories are more similar than they are different. I want to be able to actually bring people on to connect, right? To give you other resources that you didn't even realize were in your backyard or that you could assess or have access to because we are in a global environment, right? And so with the interweb connecting and doing what it does, it allows us the opportunity to get resources that we did not think we could get in a manner that is totally different and in ways that we can actually leverage for our businesses and for those things that we are in the process of building, right? So today we're going to actually be breaking some things down. I'll be sharing my screen with you all momentarily. This is the long anticipated offer and compromise episode. If you've listened to the episodes before, I broke down the different remedies, relief mechanisms that exist. We're going to break these things down a little bit more. I really want you to understand the things that make up an offer and compromise, the things you need to be aware of. And we're going to actually take the time and go through the pre-qualifier, right? The offer and compromise pre-qualifier, so you can actually before you actually talk to a professional, you can use those tools that are available to you so that you can go in and you can have a more informed conversation. I am for anybody who's my client knows this. I am for you being an informed consumer. Why? Because stuff sounds good, and marketing, those who do marketing do a great job of marketing, right? Marketing plays on our emotions. It gives us the urgency to get something now instead of later. It meets that need. It fulfills that desire that we so have to feel wanted and inclusive, that I really do want us to pay attention to what it does for us. So therefore, I want us to understand everything behind it. Like, I'm not a marketing expert. I have studied marketing, was one of my favorite classes in college. However, I am not a marketing expert. I do a lot of market research because I want to be an informed consumer. I like to know the benefits. I like to be educated. I like to pay a fair price. So I want those who work with anybody in this service industry, especially doing what we do as accountants, as tax professionals, I want you to be educated and empowered to make the decision that is best for you. Why? Because we are all offering different stuff at different experience levels. And even the work experience with us is going to be different depending on whom you work with. So I really want you to be able to have an opportunity to experience what you need to experience for you, right? And I want you to be informed knowing that. All right, so that is who I am. That is what this show is about. I know it's a long-tailed explanation is what happens on Talks with the Tax Cop, but I really, for those who are new, I really want you to understand what you could be getting into on any episode, okay? Today's episode, we are focusing on all things offers and compromise. so you don't be compromised. I don't want you to be in no compromising position, so you got to know what the rules are for an offer in compromise. So that is what we will be talking about today. That's going to be the meat and potatoes of our podcast. But before we get into that, I just kind of want to last week, like, tell y'all what happened. Like, last week was an emotional week for me. I ended up crying a thug tear, y'all. Cried a thug tear because I took my oldest to college and definitely just knew I was not going to. It's not the first time he's been away from home, nor will it be the last time he's away from home. Come on, he just turned 18. He turned 18 on Tuesday. On Wednesday, the whole family took him to college. And when the youngest, y'all might have seen him in an earlier episode, photobomb my stuff, right? So it's Alistair. He's in the episode where I'm interviewing him. When his younger brother hugged him, and it was the way he hugged him, it got to me. Like, when he hugged his sister and everything, it really was like, oh, I'm releasing him, right? So the simple moment, I'm releasing him into the wild to do what he needs to do to become the individual and the citizen that God has deemed him to be. And I think for all of us to see the interaction, you don't really know. Like, I'm the oldest of 3. He is the oldest of 4. You don't really understand the impact until you watch how your siblings react to you. You think you get it, but you don't get it. And so I know when I went off to college, I did not have that same experience. My brothers didn't go. My parents dropped me off. My brothers weren't there. I realized later, with the relationships I have with my brothers, the impact and those things that you do and the things they pick up just because you are the first. You the older sibling, the parents trying stuff with you, right? And so I did not realize the impact truthfully until that moment, because the vast difference. My youngest is 6. My oldest is 18. That's crazy, right? Because you looking like, girl, you don't look old enough to have an 18-year-old. I know. It be happening that way. But I got an 18-year-old. You probably thinking, girl, you too old to have a 6-year-old. It's cool. My husband loved me, right? So but to watch the interaction between the 6-year-old and the 18-year-old, just it reminds me of, like, me and my youngest, my baby brother are 6 years apart. We got a brother in the middle who's 3 years apart between both of us. To watch that age difference, you like, oh wow. In the age of technology and the things that are happening and what life will look like for them years down the road, it really just it got a tax cop, and it made me have a thug tear. On another note, that same 6-year-old pointed out to me that he wanted to understand what I needed to do to be a tax cop, and he said, and I quote, "How many tax cops are out there?" And I told him, "It's only one." Why? Because I have copyrighted the tax cop, right? And he was like, "Huh?" Of course, he's copyright, like, not copyrighted. I trademarked. He's like, "Huh?" And I'm like, "What?" So I had to break that down to him. And he was like, "I feel like every family should have a tax cop." And I don't disagree with him. I think everybody should be aware of what's going on in these tax streets. And so that's what we do here at the Tax Cop podcast, Talks with the Tax Cop, so that people can be able to, put some stuff in their arsenal that they learn for yours truly, so that they can leverage it for their family. All right, so that's kind of like really quickly my weekend review, what kind of threw me off a little bit. But I'm back, baby, I'm back. Any kind of food could see that I'm here, and that we are going to jump in automatically to the next segment of our show called Audit and All. All right, so now we're in the Audit and All section of our show, and I just want to things you could be audited for, right? So I'm gonna go to our trusty, dusty, show enough Bradford Tax Institute letter, right? There was an article. I subscribe to the Bradford Tax Institute. Anybody can subscribe to the Bradford Tax Institute. I actually will put a link into my description, right? It's helpful. It's some great information. They do a great job of taking tax situations, tax um, topics, and putting them in plain English language and giving you some great language, great examples, and backing it up with the code. I'm always about demystifying everything, all things tax. And so today we're going to talk about, the article says, are corporate advances to the owner loans, dividends, or salary? We're going to ask that question again. Are corporate advances to the owner loans, dividends, or salary? So y'all probably like, why is this an audit and all? Like, why shouldn't it be in balance in the beat where she teaching us and stuff? No. Today we're going to be talking about it because this is how it goes. If you operate your business as a C or an S corporation, and if you loan money to the corporation, what you say? If you loan money to the corporation or the corporation loans money to you, here we go. This is the audit portion. You need documentation that the loan is a loan. I'm going to say it again. This is why this is an audit and all. You need documentation that the loan is a loan. So if you loan money to your corporation, and I'm going to say not just a corporation, if you loan it to your S Corp, if you loan it to your C Corp, if you loan it to your partnership, if you loan it to your sole proprietorship, if you're loaning money to your business, and or your business is loaning money to you, you need documentation that supports that the loan is a loan. Otherwise, it can be looked at as either compensation or a distribution depending on your entity. Y'all got it? All right, so let's go further. All right? With the S corporation, the loan that fails as a loan can result in taxable wages to you. What she say? Compensation. If you don't have the documentation to support it, it can easily become compensation. In other words, become taxable somewhere when you didn't intend for it to be a taxable transaction. With the C corporation, the loan that fails as a loan can result in taxable dividends to the shareholder. What? So where you was thinking it's a distribution for C corporations, when you take that distro, it becomes a dividend, a taxable dividend. That's how we get that double taxation. All right. However, we got an example here. I'm about to jack this dude name up, right? Nariman Tiamoran got a real shock when at the end of the IRS audit, y'all wonder is it an audit and all? Cuz it's an audit, right? The IRS claimed that he owed over $600,000 in taxes and penalties, primarily because he had received advances from the corporation in which he had a majority control. 600,000 in taxes and penalties. Let's talk about it. The good news is Mr. Taylor won his case in court and paid zero additional taxes. The bad news is Mr. Taylor had to go take his tail to court. All right? But he won, y'all. But he had to go. Right? If you own a C corporation, pay attention to your advance accounts. A lot of y'all don't own C corporations. Most of y'all probably own an S corporation, LLC that's being taxed as an S corporation because that's what's hot in these internet streets and what's hot on the Instagram. I get it, right? However, when the IRS looks at your advance account, it can make one of two decisions. The advances can be loans from the corporation to you, or the advances are disguised dividends that should be taxable to you. Okay, so now if you're an S corporation, it wouldn't be dividends. It's compensation, right? So they'll be looking at a way for it, and we'll talk about reasonable compensation in the next couple of months because that's going to be a hot topic, right? It's low-hanging fruit for the IRS. It's on a short list. The advances are disguised as dividends if it's a C corp, as compensation, right? If you're an S corp. Now, you might be like, well, I'm just a regular LLC. So, Patrice, that doesn't really matter. You're right, because y'all don't get compensation or tax on wages and stuff like that. You take distributions. or owner's draws. That's what they're called, owner's draws. However, if your intent was that to not be a draw and it really was a loan because you wanted to pay it back, like you want the company to pay it back down the road, you need to do some stuff the right way. You need to actually draw up loan paperwork. You need documentation. I told y'all, as an auditor, the first thing they teach us as auditors is that documentation. And when the IRS representative comes in to ask you some questions, even before, when they send a correspondence audit or anything, they gonna ask you for documentation. They gonna say, send a letter, fill this out, fill this form out per our regulations, and also provide the supporting documentation, be it bank accounts, be it documentation, be it slips, be it interest payments, be it your general ledger, documentation to support how you got to that conclusion. And they're going to dig through all your stuff. And they're either going to allow or they're going to disallow certain items. Okay? All right. Y'all with me? Y'all still with me? Like, say you with me. We with you, Patrice. All right. Mary talking about myself, right? So the Tia Moore story was this. Mr. Tia Moore was building a home. His corporation made some big advances during the building effort. The paperwork between Mr. Tia Moore and the corporation was nowhere near close to being perfect. And that triggered the problem with the IRS. What? we giving the IRS ammunition. Like, what are you doing over here? It's some big numbers. So I'm going to pause here and say, like, if I'm preparing anybody's tax return, I've had this conversation recently with a business owner. I'm like, let me explain to you. And it was on a Schedule C. It was not even an S corporation or a C corporation return or partnership return. It was on a Schedule C. And I was like, I'm going to tell you, I feel like this is going to flag. That's actually the conversation I had. I feel like this is going to flag certain numbers in here. I'm not saying they're not legit business expenses. You're a business owner. If you can support the information that's on here, I prefer to see the documentation so that I can back it up and be like, how did you get to these numbers? I like to audit my clients before we ever get anywhere and I get some letters. That's just who I am. I want to know how we're getting out of the situation before a letter comes. Not everybody acts that way. And yes, it's above and beyond my due diligence as an enrolled agent. However, I don't want to get caught with my big girl pants down. I just don't. I don't want to be explaining certain stuff that's unnecessary. I don't want to be asking, then the next thing you know, the IRS not only looking at your tax return, they in here looking at how I run my firm. I don't want it. I don't want it. Then I got to go justify. That's time away from what I should be doing, which is being able to record videos and serve clients and do podcasts and do the things I really want to do. Okay? So I make sure those things are in order so that we can actually be able to be ready. So we don't got to get ready. What in the world? Did you get that? Did you say you had? Send it to me. Put it in the portal so I have it. So that we can build our case before the case comes. Then I can move faster. Then I can just be like, oh, okay, let's try to keep this as a correspondence. Anybody tell you, I just went through an audit and we just got it approved. It took us maybe about 30 days. And the representative was like, Patrice, do you got a documentation? I had a documentation. I sent the documentation. Boom. They sent us a letter. We just got the letter back last week with us just trying to figure out penalties. That's it. Yep, your documentation was sufficient. You good. Your client don't owe no more tax. We do have some penalties that we want to assess. Woo! All right. Do we want to go reasonable cause to get rid of the penalties or not? That's a conversation I have with the client. But I just want to be in here doing correspondence audits, or I want to turn an audit into a correspondence audit so that we don't got to go to court. Now, if we got to go to court, if I got to do a hearing, I've done virtual hearings and stuff like that at the state level and stuff. But if I got to go to court, I want to be ready. And we'll on this podcast, we'll be going through court cases too, so y'all can understand some stuff, right? I don't want you being out here, I can represent myself. Like, no, let's not be doing all that when we don't have to. We don't have to. Let's get our documentation together and understand what our we got taxpayer rights and things we can do and what we can't do. But the more we have ahead of time, the better we are. Okay? So let's go back. Key point, Operating as a C or an S corp. If y'all out here in these S corp streets, requires that you be pretty good at paperwork. Mr. Tiamori admitted they said he was not close to perfect. You need to be pretty good with paperwork. Get your stuff in order. Make sure you are not piercing your corporate veil. Make sure you have your documentations, be it on a drive or something in the cloud, on a flash drive. Get you some documents. There's plenty of templates out there. Get you some documents. All right? Mr. Tiamori won his case, but he also had the displeasure of the IRS company in court. Now here you go, to-do list. Here are 7 magic questions to which you want to answer yes to ensure that your advances are treated as loans. We being the Bradford Tax Institute, structured these as after the fact questions because you will be giving your answers to the IRS after the fact. So if you can answer these questions up front, right? If you think about these questions up front, then you already have them in your file. Or you can use this as being proactive and planning accordingly. Who don't like tax planning built into a podcast? Come on. High five yourself. I need some more sound effects, y'all. All right. So here are the 7 questions. Number 1, did you sign a promissory note or other document promising to repay the money to the corporation? You know what we're going to do? I'm going to actually stop here because I want y'all to see these. Anybody who's coming online and they're like, wait a minute. Okay, let's see if I can switch the camera. I locked it to that camera. I'm going to use a different camera. Can I switch camera? Nah, my thing is locked. We're going to go with it. Wait a minute. Here we go. Let's scroll. Y'all can see my questions? The Bradford tax questions? All right, here we go. Some of it's off the screen, just a tad bit, okay? Did you sign a promissory note or other document promising to repay the money to the corporation? Did you? If you didn't, y'all better go get you a promissory note off the end of this. Did you pay interest on the advances? Now, I'm going to tell you this right now. That interest one, I've seen a lot of court cases that's where people get themselves caught up. They are not like treating it truly like it was a loan that they got from someone else, and they have not built interest into the promissory note. Now, if your promissory note indicates that you have 0 interest, that's a different story. However, you want to act as though you've gotten a loan from a bank or somewhere else because that helps to prove your case and not that you're not trying to just disguise compensation or a dividend, okay? Did you make payments on a fixed monthly, quarterly, or other schedule? All of that should be laid out in your promissory note or in your terms of repayment. Did you give the corporation collateral to secure your repayment? Did you repay the loan? Aha. Were you making them payments in accordance to the schedule that you laid out with yourself? Did the corporation check to make sure you had the ability to repay the loan? Did it look at a credit report or a statement of net worth? Now, that's a new one for me because I haven't done that and I haven't told clients to do that in the past, but that's an interesting one. Hey, I did some background check and because of this, and then maybe that's why my interest rate is so high. It's because, I might not be as reputable. Who knows? I'm just throwing ideas out there, y'all. Did both you and the corporation conduct yourselves as if the advances were loans? In other words, did you act like you would if you had gone to the bank and got money from somebody else? Or are you actually just trying to disguise it like it's compensation? Remember, if you are asked these questions today about last year or the year before, you want yes answers. That does not mean people go out here and just be putting yes to be putting yes. So I can tell you, in most cases, a lot of my clients would have a yes response to 1, 2, 3, 4, 5, and number 7. They may have to answer no to number 6 because this is the first time I'm like, you know what? I hadn't thought about doing that piece. Everything else I'm very familiar with. And I'm like, okay, do we have a promissory note? Do I got a copy of the promissory note? Did you send it? Does it include interest? Like all those things are things I normally talk about. Do we have an amortization schedule if it's over a year? Those type of things. I tell my client, let's generate. Number 6 is a new one for me. I'm out here learning in these streets too. I'm for it. I'm for it. Are y'all for it? I'm for it. I'm for it. I'm for it. I am for it. Let's see which camera. I like this. I'm for it. I'm definitely for it. Right? For it. Y'all probably watching all of it like, oh, that's how she doing stuff. I'm for it. I'm definitely for it. Okay? All right. The biggest takeaway, I've said this to people. I want y'all to know this. If you fail to document loans between you and your C or S corporation, only bad things can happen should you, I'm not going to tell you that you will, should you face the IRS and an audit. Be prepared that they're going to find out that you was unprepared if the IRS come a knocking. Period, point blank. Be prepared that the IRS could easily say, hey, you was unprepared. You don't got documentation. And therefore, they may go back and do what? They may go back and disallow things that you weren't ready for them to disallow. Meaning you could end up paying additional tax on something you never intended to pay additional tax on. And I don't want that for you. All right? That's this week's Audit and Awe segment. Hopefully you got some nuggets from it. We'll put those 7 questions, things to think about, you know what I'm saying, somewhere. Like that's really good. Go ahead, Bradford Tax Institute. And if you want to know how to get a copy of the Bradford Tax Institute, a subscription to the Bradford Tax Institute, I absolutely love it as a tool to break things down in plain English. Stuff that's already been broken down in plain English for some clients on certain topics. I will share certain articles with my clients just so that they can understand it better, so that when they want to have a conversation with me, then we can have a conversation from the same playing field using plain English. All right. And like I said, I love it because it's plain English and it's backed by the code, and they went and summarized a case. This is a case that from 2005. Okay. All right. So that's this week's audit. Let's jump into the meat and potatoes, y'all, of... Oh, look at me playing and fancying and doing some stuff. Y'all, I had a whole overlay for y'all of... I'm going to play it for you. All right. Our next segment, balancing the beat. Let's jump to it. Let me see. Where we at, y'all? Where we at? Y'all are like, where you at, Patrice? All right, this is where I'm at. Here we go. Let me see if I can make this a little bit smaller so we see the whole screen. I have it on 75, 175. All right, y'all can see this is from the IRS. Y'all know I'm big on going to the source, right? So this is topic 204, offers and compromise. We're going to break this down. I'm going to hopefully get to a run through of the pre-qualifier, but let's break down when you can do an offer and compromise. What an offer and compromise is, those great things. Okay, this is topic number 204. I done made this. Let's expand back out. Why did it go out? Y'all, me playing around with my stuff. That sounds terrible. I didn't say it like that. All right, me playing around with the screen. That was not my intention. All right, so for those who are watching it real time, I don't want to make it large enough for us to see. My background ain't crazy. I'm touching the wrong screen. Okay, here we go. An offer and Here we go, because I want y'all to see all of it. An offer and compromise. And of course, this is why I say we at 85%. I got some stuff I still got to work out in the kinks. Anybody watching the video. As a podcast, though, you're going to learn some stuff. An offer and compromise, an OIC is what you'll hear. Or, what's it? Fresh start program or something like that, right? That all falls up underneath different terms we give it, different marketing terms. That's what I told you, be an informed consumer. An offer and compromise is an agreement between a taxpayer and the Internal Revenue Service that settles a taxpayer tax liabilities for less than a full amount. So essentially what is going on is just like what you would do with your credit card. We selling stuff for pennies on the dollar. We owe this liability. Now let's go back. Y'all know how I feel about this when we talk about this topic. You actually owe the money. You know you owe the money. I need y'all to see my face on this one. I need y'all to just see me. You know you owe the money. You know that you did not pay your fair share because when it all shook out, you either had an underpayment, some got left off, this, that, and other. Like you rightfully owe this money to the IRS. But you don't want to pay the full amount. Or that payment plan, when it's stretched out, going to have you trying to give up your first grandkid. And you don't want this. So we're looking for remedies and you would like to pay 4 pennies on the dollar. Right? So that's where we at. You want to pay pennies on the dollar. All right? So you want taxpayers who can fully pay the liabilities through an installment agreement or other means generally don't qualify for an OIC in most cases. That don't mean all cases, in most cases. For information dealing with payment options and installment agreements and all that kind of stuff and currently not collectible and all those different options, go watch another podcast, right? I did those in earlier podcast episode, season 10, season 2, episode 10, season 2, episode 9. And I think we talk about it a little bit in season 2, episode 8. I'll let y'all know whether or not that's right. But I know season 2, episode 10, the one right before this one, we went into payment plans. No, we went into currently not collectible. The one before that one, episode number 9, we went into payment plans. So I've covered those in detail and kind of showed you what the IRS says about it. I do know that. To qualify for an OIC, the taxpayer must have, just the rules, you must have filed all tax returns. Remember I was telling you to be current? You have to pay the current tax year. So for us, we're in 2023. You would have to have paid 2022, and then they'll tell you to go back 6 years. Okay? I'm just telling y'all see, it's what the IRS has said, not what Patrice Taxcop has said. They saying it. To qualify, right? Jesus, I be cooking on the wrong screen. To qualify, the taxpayer must have filed all tax returns, have received a bill for at least one tax debt included on the offer, made all required estimated tax payments for the current year. Also, that means withholding. Make sure you're withholding the right amount. And if the taxpayer is a business owner with employees, come on, business owners with employees. The taxpayer must have made all required federal tax deposits for the current quarter and the 2 preceding quarters. In other words, you better pay your trust fund stuff. Them payrolls, you need to have paid them. You got to be in a good stand. Like, we're not out here all willy-nilly. So sometimes, remember I told you, we may be stacking remedies to get you to a point where we can get you here. Automatically, that's why I say, if you can fully pay, that may, in most cases, you may not qualify for an offer compromise. But it may depend on the situation. We're talking dollar amounts and things like that. And sometimes we have to use different strategies for different times to get you to the position that we really want you to. That's why when it gets to be intricate, amounts get to be too much and you really want an intricate strategy, sometimes you need to work with a tax professional to get there. I'm not going to tell you got to always work with one. But sometimes you do. so that we can stack certain things and we can do some assessment. That money can be well spent if you are working with a well educated, well experienced CPA, enrolled agent, or tax attorney that is familiar with resolution. Okay? In most cases, the IRS won't accept an OIC unless the amount offered by a taxpayer is, drum roll please. Oh, I got a drum roll. Hold on, let's see if we can do the sound effect. That was the wrong kind of drum roll, y'all. That was terrible. That was like in your face. I ain't mean that. No, that was the wrong. I need to go give me a different drum roll. Okay? In most cases, the IRS won't accept an OIC unless the amount offered by a taxpayer is equal to or greater than the reasonable collection potential. In other words, if you were to fully pay, how much of that money I'm really going to get? Because I want as much as I can legally get, because you what? Look at me now. Y'all owe them people that money. Rightfully. That's a balance due that you owe. They want their money. Okay? All right. Let's get back. Okay. The reasonable compensation is how the IRS measures the taxpayer's ability to pay. It includes the value that can be realized from the taxpayer's assets, such as real property, automobiles, bank accounts, and other property. That does not mean they're going to snatch it. They just want to know about it. In addition to the property, the reasonable collection potential also includes anticipated funds, right? Anticipated future income less certain amounts allowed for basic living expenses. So let me break this down in plain language. They not making the assessment on how much money you got today. I ain't got no other way to tell you that. Okay? Let's just be real. They not breaking it down on how much money you got today. That said future income potential less other expenses. So we doing a financial statement, y'all. I don't know no other way to tell you. We looking at income minus expenses, and we are considering not just your income today and how much we got assets is on your balance sheet, right? So we do got balance sheet information. We got liabilities, credit cards, and stuff that you owe. I'm not going to tell you that's not considered, right? Assets, cash, those are assets, right? Real estate, automobile, those are assets. That's balance sheet information, right? But they take that balance sheet information because I need to know I need to know what you really got. What you got. Who you owe. And then I compare it to, girl, you teaching an accounting lesson up in here. All right. I compare it to your future income. And I subtract expenses from that. Let's go back because I don't want y'all to say the tax cop in these streets lying. They take assets such as real property, automobiles, bank accounts, and other, that's balance sheet information. In addition to the property, RCP also includes anticipated future income. Right there. Anticipated future income less certain amounts allowed for basic living expenses. Now, the IRS has their own log on them future living expenses. Right? But I want y'all to know, so when people come to me, I be like, look, this is what you look like now. Yeah, we got to take a snapshot in time, but be mindful. This is a different IRS. We could be in an offer and compromise situation waiting to hear from them for 18 months. What? Yeah, I said it. 18 months. We waiting on them. We submit the paperwork. We make sure we have all the documentation. We package it up right, pretty with a bow, and then we wait. Because it's the government. We sit there and we wait for somebody to review it and assess it, come back and ask us for more documentation, right? To see whether or not you're telling the truth. Because you got a dry snitch on yourself. It's not like your W-2 where your employer dry snitching on you. This is a situation where you're dry snitching on yourself. Okay? All right. Y'all got it? Here go the reasons for the offer. The IRS may accept an offer in compromise based on one of the following reasons. The doubt as to collectability. A compromise meets this criteria only when there's a genuine dispute as to the extent of amount or the correct tax debt under the law. If it's a doubt to collectability, meaning, hey, I might not be liquid enough for you to even get this stuff before the money is up, right? Doubt to liability is, hey, it ain't on me. I don't believe I owe this debt. Doubt as to collectability is, it exists in any case where the taxpayer's assets and income are less than the full amount of the tax liability. I don't got it to be paying you. Nor in the future am I going to have it anywhere in the near future to pay you. You just might not get no money. I'm just going to tell you want something? I'm either going in a CNC currently not collectible, or I'm going to pay you pennies on a dollar and we just going to be like, we done for, you watch me for 5 years. That's what it is. That's doubt as to collectability. Third, the IRS can accept a compromise based on effective tax administration. When there is no doubt that the tax liability is legally owed, right? So, hey, I know I owe you that money, and that the full amount owed can be collected. And truthfully, if I really wanted to, I could find a way to pay you in full. But requiring payment in full would either create an economic hardship or would be unfair and inequitable because of exceptional circumstances. I could probably get you the money. However, if I do that, there's something else that's going to happen in my household that's going to cause me hardship. Them are the 3 reasons. And we have to disclose one of these 3 when we go to submit an offer in compromise. Is it, hey, I don't think I owe this. Or I don't think y'all ever gonna get no money from me. And if you want something, then you're going to have to settle for pennies on a dollar. Or effective tax administration, which is, I owe it. I could possibly pay it in full, but it's gonna hurt me and my household if I go that route. And we got to prove it. How do we prove it? A lot of people could fall in this. I'm not going to tell you. I've had some people doubt as to collectability. I've had it, right? I got some people who need to be in an effective tax administration. But when we go to do their financial statements, I can't prove it. Right? So let's talk about it. Let's talk about it. All right, the forms to use. When submitting an OIC based on doubt as to collectability or effective tax administration, taxpayers must use the most current version of the offer and compromise form, Form 656. That's our offer and compromise form. We got to also submit a Form 433A. That's a financial statement, y'all. They want your business. This is why I tell people when people come to see me, be very mindful if you come in the door and you automatically scream an offer and compromise. Because you're going to have to cough up the goods. You're going to have to dry snitch on yourself. You're going to have to fill out a financial statement. You're going to have to give them supporting documentation. And I mean supporting documentation because they're going to ask you about bank statements. They're going to ask you to prove leases. They're going to ask you to prove card payments. They're going to ask for life insurance information. They're going to ask, right? They're going to ask for TSP for those in the gut. They're going to ask for the documentations. And you're going to have to give it up. Card payments. They're going to want to see statements. Like, you can't just be putting stuff on there like when you're trying to apply for a loan and be like, maybe they'll never go check. They're going to check. It's a person looking at offering compromises. Y'all, I'm looking and a bus flying through my neighborhood. School bus at that. Anywho, they gonna check. The IRS gonna check. And y'all gonna have to tell the truth. Cause didn't I just tell you this is why we did what we did in audit and all? Documentation. Like, don't waste their time. Don't do it. And don't waste your tax professionals' time. Don't waste your tax attorney's time. Don't waste your CPA's time. Don't waste your enrolled agent's time. Don't do it. If you're gonna go in this is a partnership. It's us advocating for you to see if we can get you to pay pennies on a dollar, you're going to have to cough it all up. Because I noticed, because I've been in this experience, the IRS will come back and be like, did you know about this property from 1952? They did this, and this. What's the status of the property? How much money did they get from the property? They sold it in 2008. Why couldn't they have paid that back? I'm like, huh? Disclose it. Disclose it. Because if you disclose it to the tax professional, to the enrolled agent, to the CPA, to the tax attorney, then we can come up with the best strategy really for you, because now we know everything to be able to find the best remedy for you. Don't have us out there representing you and you looking and we don't know. Have us be on your side and provide the docs. All right, I digress. I don't. It really means something to me, right? Then we have a Form 656L. So that's the only thing that's different. A 656 offer and compromise, or a 656L. So we do the 656 regular offer and compromise and give the 433 OIC for individuals. That's financial statement for individuals, or a 433B for those business owners, right? But if you're doing doubt as to liability, hey, this not even mine. We got to do a 656L. We still got to do 433 A's and B's if you got a business. We got to still give up the financial statements, but we just do a different form, 656 offer and compromise form. It's just different. And you want to make sure that you are using the latest and greatest. Now, I tell you, sometimes these forms change, and it's been on somebody's desk for 18 months, and they like, you used the wrong form, and this, that, and the other. They should be paying attention to the day that you submitted it. They should be. I'm not going to tell you that they're not. All right, now, there's a fee. There's a fee that you have to pay your professional that you're working with, but there's also a fee you got to pay to the IRS. In general, a taxpayer must submit an application fee for the amount stated on Form 656. Do not combine, do not combine this fee with any other tax payments. However, there are two exceptions. Always. Everything in accounting always is. Depends. Maybe, but it depends. Okay? First, no application fee is required if the OIC is based on doubt as to liability. But remember, I told you a lot of times I haven't ran across too many people where it really is a doubt as to liability. Like, I really don't owe this. I don't think this 100% belong to me. Like, okay. Second, the fee isn't required if the taxpayer is an individual who qualifies for the low income exception. Now, I have gone through this before, where I had someone who we worked with, and they were considered low income, and we did not have to file a fee. So that I'm familiar with. There are two alternative options for qualifying. The first is that the individual's adjusted gross income, as determined for the most recent current taxable year, for which such information is available, most recent, falls under or below 250% of the poverty guideline, and we can figure out what the poverty guidelines are. Normally, I think it's like $40,000, something like that. The second is that the household's gross monthly income is 12 months falls at or below 250% of the poverty guidelines published by Department of Health and Human Services. Either way, we have a guideline that we're using to determine that. Okay? A taxpayer who claims the low income exception should check the appropriate certification when we turn in the application. That way they'll know, and they won't be looking for a fee. Because sometimes they'll just be like, well, you didn't submit the fee, and they'll be dismissive, and you're like, whoa, we done waited 18 months. Now you're just going to throw it out. We just forgot to check. There was a lot going on that day. Let's make sure that we check the box. Check us to check the box. Okay? I'm going to end up having to do a part 2, right? Because audit and all got so good to me. It did. All right? Payment options. Lump sum cash offer. Taxpayers may choose to pay the offer amount in a lump sum. Right? So that means, and you're like, wait a minute, if I don't have it, how am I going to pay something in a lump sum? It's your offer amount. Right? And a lump sum is defined as 5 or fewer installments. So let's say you owe $60,000, but you're making an offer of $5,000. and the IRS go with that. You can either split that $5,000 into, this is your, because now they like, you know what? You ain't doing that with the 60. We go in exchange for that 60,000. We'll take the 5 based off of the information you gave us. You qualify for an offer and compromise. We gonna take the 5,000. You can make that $5,000 payment in 5 or fewer installments, or you can pay it in full. I got the 5,000. Can you just make it all go away? Yup. That's what that means. That's what that lump sum cash offer is. The 20% payment is generally non-refundable. They got to put down, 20%. That's like your good faith estimate. Hey, I'm gonna give you 20% though. I'm gonna give you at least 20% of this, or you can give it to them all in full. Okay, or you can do a periodic payment offer. A periodic payment offer is payable in 6 or more monthly installment payments, but it's got to be paid in full within 2 years, 24 months. I've had clients do both or attempt to do both, right? Some of them have been accepted, some of the offers, and I won't lie to you, I've done offer and compromise. Some offers have been accepted, some offers have not been accepted. Why? Because everything was looking bleak until we filed that most recent tax return. And they had sat on an offer for a long time. Had they accepted the offer before then, before I had filed the most recent tax return, the offer would have went through. But you know what I'm saying? The grass ended up being greener when I filed that tax return. And it was like, nah, future payment, nah, go ahead. Nope, go on somewhere. You need to try something different. It's not going to work. That's why all of it is strategic, and it has sat on somebody's months. Does the candidate qualify for offer and compromise? At the time we submitted the offer and compromise, I'm not gonna lie to you, my candidate did qualify all day long. Everything they gave me, they qualified for it. They ended up having a really good year, and stuff turned up for them. So by the time 18 months later, it was considered, they asked for more. They asked for 3 months of the most recent payments, and they looked at the most recent tax return, and they factored in distributions from their company, and they had taken out quite a bit. The company actually did well, and that's what changed the situation for them. So you're like, well, why'd you even submit it? Because at the time I submitted it, they qualified for the offer. It sat for 18 months. By the time they got around to processing the offer, the client did not no longer qualify. That's why I'm stressing the fact of the future. Understand that this could be a more lengthy process than you even considered. All right. Suspicion of collection. Ordinarily, the statutory time within which the IRS may engage in collection activities is suspended during the period that the OIC is pending. Right? So we call that, while it's waiting to be processed, to either be accepted or rejected, collection activities got to stop. For 30 days immediately following the IRS rejection of an OIC, and for the period in which a timely appeal rejection is being considered by the IRS Independent Office of Appeals. Right? Suspension, collection activities got to stop. We got to put that joint on hold. So sometimes you do it, like I say, sometimes we do certain things. It's just, you know what I'm saying? That's the battle of the beast. Sometimes we doing strategies in different manners for different reasons. That's all I'm going to say with that. I'm going to table that one. Right? Offer terms. If the IRS accepts, this is what I want y'all to understand. If the IRS accepts the taxpayer's offer, the taxpayer will have agreed to fully comply with the tax laws. The IRS will keep any refunds. They're going to apply any payments you made to take off them debts. So at the same time, for those, even while we're waiting for it to be processed and it's pending, we are making payments in good faith, saying, hey, I agreed to do this. I'm going to pay these payments while it's pending. So I'm telling you that client I had, they were making payments the entire time, the entire 18 months they was making payments with the hopes that they was going to accept the offer, and then we would just knock everything out by that time. They take those amounts, whether they accept it, reject it, kick it back, whatever, and they apply it to the tax years. It's sitting in a kitty. This the offer. We either gonna apply it to the offer and get rid of the outstanding balance, or we gonna collect it and we gonna apply it to tax it. Like if it don't go through, we gonna take that and we gonna start using it to deduct balances. That's really what this is saying. Okay, that whole paragraph. This is me summarizing. I'm telling you how it works. If the taxpayer defaults on a payment, y'all, that offer in compromise could get kicked out. They give you a letter and tell you, hey, you need to be back in good standing. So you gotta adhere to the terms. Like you saying, hey, in good faith, I'm trying to clean this up. These are what I'm doing. You gotta adhere to them terms. You gotta adhere to, because you do not want to get kicked out for no reason. You gotta pay, but this is the deal. After they accept that offer, there's still rules. You need to pay, and you got to pay. You got to timely file. That means even with your extension, you got to timely file, and you got to pay everything you're supposed to for the next 5 years on time. Or the IRS could go back and be like, you know what? You didn't keep your end of the bargain. You owe us all that money that we just forgave you for. I'm gonna say that again. You have to, after that, you locked in for 5 years for doing the right thing. That means you need to file your extensions. You need to pay on time. So even if you're doing an extension because you want to buy more time to file, but you still owe, you need to pay that on April the 18th, April the 15th, whatever, in full. Because they're not going to put you on a new payment. They're not doing all that. You gotta be in good standing, because now you've locked in. We agreed to give you this offer. You gotta do the right things. This is, hey, we are redeeming you. We are wiping your slate clean for pennies on a dollar. Now you have to abide by the rules, get in good graces. Do it the right way. That's what this is saying. Okay? The terms for doubt as to collectability in effective tax administration, OICs, which I told you, most people are in effective tax administration, OICs. The terms and conditions include a requirement that the taxpayer timely file all tax returns and timely pay all taxes for 5 years from the date of the acceptance of the OIC. When the IRS terminates an OIC, the agreement is no longer in effect, and the IRS may, it doesn't say they will, but it says may then collect the amounts originally owed, less payments made, plus interest and penalties. You do not want to be in a situation like that. You just don't. It's not a good look. Right to appeal. If the IRS rejects an OIC, the taxpayer gonna be notified by mail. We will. They'll call us and let us know. Hey, we can I'll tell you, this is really what's happened. Hey, I'm gonna reject this unless you pull it. The letter will explain the reasons the IRS rejected the offer and will provide detailed instructions on how the taxpayer may appeal the decision to the IRS Independent Office of Appeals. The appeal must be made within 30 days from the date of the letter. Now, we can do this one of two ways. I've had them call and say, hey, look, I'm going to reject this, or you can pull it. Now, when you pull it early, right, you can pull it and then resubmit based off of different terms and stuff like that, right? Because as it is, I'm going to reject it. And when I reject it, this is what's going to happen. And you got 30 days to appeal. Or you can pull it. And understand, when you pull it, right, you say, no, I don't want to do the offer. I want to go back to the drawing board. You waive your appeal rights. And I've done that for clients where I've been like, what, you going to reject it? Okay, I need to do a different strategy. I want to attack this. It's not that I don't think they qualify for offering. We just got to go back to the drawing table. I now know your hand, right? You just showed me the cards. Okay, and this is why, or you going to come at me like that? We're going to try this a totally different way. Clients do get upset, but the amount of your payments that you've made during that period of time still goes to apply to outstanding balances. And my clock is still ticking. Now I'm out of collections. Now I'm back into collections. Now we're doing all this kind of stuff. I'm looking for a different remedy. I'm going to the table and going to try a different strategy. And one of those strategies might be like, all right, y'all, let's go back. Let's tighten some stuff up. You did this. All right, what's your situation? Okay, you barked this. You did this. You did. Let's go back and let's go after that offer. I know this. I know that they know this. I know they know this. I need y'all to tell me this. Let's go back after the offer. Let's do it a different way. Let's look at what the situation looked like now. Let's go after the offer. Okay, you got this. You just lost that contract. You're not gonna have distributions like that because we having the supply chain impact. Let's go do this different. I'm gonna pull it. Let's go do a new offer. And I may not have to offer as much. It depends on the taxpayer situation. Y'all got what I'm saying? But you got to work with somebody who understands what's going on. So sometimes I won't. This is me. Somebody else might be like, "Yeah, I'm going because I'm gonna go to appeal and we're gonna do this, and I'm willing to fight." And I got it ready to go in 30 days. I ain't gonna lie to you. I've had people that I've been like, "I'm pulling it. I'm pulling it because I want to do a different strategy. I want to try a different approach. I want to do this and this, that, and the other, and let's knock this. Let's do this. I want to go at it a different way." Or they might have, or they liability may have increased. So I might want to be like, "Yo, you added more money to it. Okay, we got to do this a little bit different." Now I tried effective tax, right? Administration. Now I might do doctor collectability because I'm watching what's happening. Not only you did this, you had more money. You also now have lost your contract, and I'm looking at the circumstances. I'm like, "Yo, I think we could do this better, and under this way, we would be in a better position to get the offer." Now we might have to sit on this, and life could happen, and you could be back in a position where you're making more money. But I want to take a different approach. Let's start over. I don't want them to reject. I want to pull it. Let's try it a different way. That's me. Everybody ain't me, and I know that. Okay, y'all with me? Y'all are like, whoo. Is she teaching or is she teaching? I'm teaching. I'm just telling you, that's just how I think. I'm always, this is chess. I'm always looking for ways to play chess. All right. Next week's episode, we actually are going to go into the offer and compromise pre-qualifier. There's a whole 656B, but I want you to know what this is. I thought we would get to it. I'll spend less time in audit and all. I just thought audit and all was a good one because, especially because we are at extension season, and I'm gonna be asking for documentation. Or you have people like looking for strategies, and they like, "Wait a minute, I did that, and that really was a loan, but I didn't document it on my financial statements as a loan." And if I'm ever audited, I don't want to be in no situation like this. My whole goal is to always help save you for something that you might not be aware that you walking yourself into. Okay, so y'all, I really, really want to thank you for the opportunity to spend time with you today. I try not to let these things go too long. Y'all, I love the tax code. The tax code is so exciting and so beneficial if you know how to play the game and know how to leverage it and know how to use it to your advantage. And I really want to be able to give you a better production of show. And I want to be able to give you better content that you can absorb it and see the Taxcop as a resource that is trusted and is willing to tell you the truth and give to you straight, no chaser, and want to work stuff out for you and your family so it's at their best benefit for them. Today's episode, you got to find out that my one of my employees, my son, yes, he's an employee of the company. He also is the producer of this podcast. Actually is now in college. Look at God, right? He better get some skill set because he's doing electronic film and media. So I'm looking for this to, like, my tunes to be better, my intros, my transitions. We're gonna look at this, right? My editing. He better use that. We paying for that. We paying for that. I want him to be the best that he can be. Shout out to Alistair Berry. I want him to be the best that he can be, and I know he will be. And he'll bring those skill sets, and he'll help me to be able to produce a better show. Shout out to my team for helping me with these things that we're using. Shout out to Ecamm Live. I actually put the link to Ecamm Live down there. Ecamm Live is helping me to give you a better production of show content so we can do clips, do what we got to do, make things better. And I just want to say thank y'all for listening. Really. Tell me things that you want to hear, questions that you might have. I'm going to have to do segments where we got to do questions. Eventually, I'm going to get to the point where I think I can do a live production of the show. I got to tighten some stuff up first. But we got our audit and all section where I'm gonna give you tips so you can be ready, or give you an example of somebody who's gone through an audit or some cases so you don't make those same mistakes. Talk about some things that we got coming down the pike. We have some audit technique. We're using the principles of the audit technique guides that the IRS has and coming up with ways to teach people in plain language. And we'll be having those on the Taxcop website in the next couple months, sponsoring our own stuff. So you actually have a workbook that you can produce and work on for your industry. Now, we ain't gonna have every industry at first, but we're gonna have some up there for you to be like, how do I really truly go about audit proofing my business and my life? And because we want to be able to serve, we want to give you resources that are practical, that are able for you to be able to grab and use and do something with, so you can get in front of anything that may be coming down the pike. Today's audit and all section, great example of loans for those who are in any business entity. How to document your loans so that they are truly loans. Those 7 questions are key. I'm telling you, number 6 got me. Number 6 did get me. And then we did a breakdown of offer and compromise, just high level, topic 204 from the IRS website. In next week's episode, we're going to actually go through the offer and compromise pre-qualifiers so you can see those things so that you feel informed. So before you call in, I'm not going to say their name or anybody else for a tax relief appointment, you can go in well equipped. Hey, I know I got to get a 656. I know it might be either a doubt of liability or doubt of collectability or effective tax administration. I've learned those things. Now, I know I got to cough up all the goods and give you a financial statement. I'm getting my documents are in order. How much is it going to cost? And it won't be cheap. But if you can save pennies on the dollar, and you can work with somebody who can assist you because you know you qualify to save pennies on a dollar, to get that noose from around your neck, why wouldn't you go that route? You'll find a way to make it go away. Look at the, you know what I'm saying, cost-benefit analysis of what an offer and compromise could do and how it can lift that weight up off you, and you won't be looking around the corner or hiding your car down the street or silly stuff like that, okay? I get it. Times are tough. Life is hard. Anything can happen. I want to thank you for taking the time out to listen to this episode and letting us love on you. We truly appreciate, adore, and glad that you spent time with us at this episode of Talks with the Tax Cop, Season 2, Episode 11. Don't be out here compromising yourself when you could actually legally qualify for offering compromise. This is part 1. We'll go on to part 2 next week. Until next time, I'll holla at y'all. Love y'all.